Good morning.
Morning, sir.
Thank you. Welcome to our class today. Yesterday, we were discussing on how to manage the account receivable, and we say that there are a number of things you can use. Okay, one of the tool you can use to evaluate on how to manage cash is the use of the cash flow forecast, which I think we did prepare yesterday. Okay, we prepared the cash flow forecast. Okay, but as we had said, the key thing you have to be careful when it comes to the cash management. Okay, when it comes to preparing the cash flow forecast. Okay, is to be careful that don't use the accruals basis. Okay, you be careful that you don't use the accruals basis. Okay, we use the cash basis when it comes to preparation of the cash flow forecast. Okay, that's what you have to be careful. You have to be careful. Okay, we only use the cash basis when preparing the cash flow forecast. Okay, and that's what we prepared one yesterday. Okay, we shall prepare another one later on. Okay. So today I want us to discuss on the cash management models. Okay, what are the cash management models that they can use? Okay, what are the cash management models you can use? Okay, there are two models you can use. The first is called the use of the Baumol model. Okay, and the use of the Miller-Orr model. Okay, these are the two models you can use to help us in determining what should be the optimal amount of cash as a company we ought to be holding or we ought to be keeping. Okay. So let's begin the first model, the use of the Baumol model. Okay, the use of the Baumol model. Okay, now the use of the model, actually, the Baumol model, okay, is so referred to as a readaptation of the EOQ model, which we did use when we were discussing on inventory management. Okay, it's actually like it's the EOQ. Actually, it's the EOQ, but now we're going to be applying. We're going to be using this EOQ model at a cash management. Okay, where therefore instead of having inventory, okay, we're going to be having cash as the encode the inventory. Okay, we shall be replacing the inventory with cash. Okay, so all the assumption we had for the EOQ will also be applying this in this case. Okay, so the different assumption we had for the EOQ also applies here. Okay, so we are trying to readapt the EOQ model. Okay, to be suitable for cash management. Okay, for instance, the assumption of the annual demand of inventory, which you had at the EOQ model. Okay, in this case, you're going to make an assumption that you can be able to estimate. Okay, what will be the annual cash requirement that as a business you'll be having. Okay, in the next one financial year, what is the cash that we're going to be requiring? Okay. If it's about cash generation, okay, what is going to be the cash we shall be generating in the next one financial year, okay? So that's the idea that it is possible for you as a company to estimate some variables, okay, to be able to forecast, okay, some variables, the holding cost of cash, okay, the ordering cost of cash, okay. So the same thing shall be applying here, okay. The same objective that we had with the EOQ, where under the EOQ, okay, on the inventory management, we did say that the objective is to estimate was the optimal amount of inventory the company should be ordering every time they make the order. Okay, every time you're asking suppliers with inventory. Okay, how much should we be? How much inventory should we be ordering? How much inventory should we be ordering from the supplier? The same thing applies here. That what is the optimal amount of cash that we ought to be, for instance, either investing, because here you are the one who's investing cash. Okay, if you have cash surplus, then of course you invest. Okay, if you have cash deficiency, what do? You're going to be trying to liquidate some of your previous investment to boost your cash levels. Okay, so therefore, every time that you're going to be investing the excess cash, in case you have more cash than all you need, okay, what should be the amount you be investing? Okay, what should be the Q? What should be the optimal amount of money you should be investing? Okay. If it's about you have a case where you have cash deficiency, okay, and you want to boost your cash balances, what do? You dispose of your previous investment, okay. Therefore, every time that you make a disposal, what should be the amount what should be the amount of cash you're going to be requiring, so that you dispose assets equivalent to the amount you want to get. Okay, what was it? What was the Q at the time? Okay, what's the optimal size of the order? Okay, what was the Q? Okay. As I mentioned, the assumption we had in the case of the EOQ, okay, also applies here, okay. For instance, you can be able to estimate what is going to be the cash needs of the company in the next one financial year with certainty, okay. You can be able to estimate in the next one financial year how much of cash are you going to be generating, how much of cash are you going to be requiring, okay, in the next one financial year. You can be able to estimate things with certainty, okay. The holding cost of cash is going to be known, okay. The holding cost of cash is going to be known. By the way, what's the holding cost of cash? What's the holding cost of cash? Sanya.
So what do you mean holding cost?
Yes, money has holding cost.
I'm
What's
not sure.
Okay, let me just explain. I know it's very easy. Okay, what's the cost of having cash at hand? What's the alternative?
Can you say it could have been used to maybe generate money elsewhere?
Okay, this money is called what? The money you'll be generating, we refer to it as
Opportunity cost.
opportunity cost, which in case of cash, what do you call it? I agree with what you're saying, but the interest, okay, the money could have earned interest for you.
Yes.
The money could have earned interest
Yes.
for you. Don't forget, the money earning money, the money to be earned is the interest, okay? Don't forget, the holding cost of cash is the interest, okay? Because the holding cost of cash, the interest you could have earned if you had to invest the money, which you didn't. So if you don't invest the money, okay, then you'll be losing cash, okay? Therefore, the holding cost of cash is the interest. The interest the interest foregone, okay? The interest you could have earned, okay? But you didn't earn. Why? Because you did not invest the money. That's the holding cost of cash, okay? And of course, you can also be able to estimate the transaction cost, the cost of, if you remember under the EOQ, okay, the cost per order, okay. Now the same thing applies here. That if, for instance, I've just mentioned that in case we have excess cash, what do? Invest that money, okay. And since this is short term, the surplus is short term, you invest in short-term securities, and you mentioned the use of the money market instrument. Invest in T-bills, invest in commercial papers. So invest in money market instrument because this is a short-term surplus cash. Okay. Therefore, don't forget you have to incur some costs. Okay, this cost of transaction. Okay, if for instance you're going to use a broker. Okay, if for instance you're going to use a broker to help you out in investing the money. Okay, don't forget the broker will charge you a fee. Okay, they do require a fee. Okay, the fee that the broker is going to be charging you for every time that they buy for you on your behalf the T-bills, commercial papers. Okay, so they charge a fee. That's called the cost of the transaction. Okay, the cost of making those transactions. Okay, then you have the farm cost. Okay, okay, the farm cash payment occur uniformly over the period of time. Okay, that's if it's about cash generation. Okay, if it's about cash generation, then you're going to be generating cash. Okay, on a uniform basis. If the first month is 1,000, then you assume that every month you're going to be generating 1,000. So you assume that there's uniform cash generation. If it's about consumption, okay, if it's about consumption, use of cash, okay, then you assume there's also the uniformity, okay, that every month you can be consuming, let's say 10,000. If it's 10,000, then for the next 1 year, the total cash to be consumed therefore being 10,000 times 12, okay. The assumption of constant consumption or constant generation of cash, okay. Here, don't forget this is simply the EOQ, the EOQ. This simply don't forget it's the EOQ, okay. Yes, back. Okay, don't forget this estimation is simply the EOQ, okay. The firm incur holding costs for keeping the cash balance, okay, and as mentioned, this holding cost is the amount of return, okay, the interest you could have earned if you had to invest this money in the money market instruments, okay, in the T-bills, okay, in the commercial papers, which you didn't earn, okay, that's the holding cost of cash, okay, you forgone, you didn't earn that interest, it was forgone. Why? Because you are holding that cash at hand, okay. The cost of mixing the order, I think I've mentioned, is the cost you've been incurring for either investing or disposing of the previous investment. Okay, and I give an example that if for instance you're going to be using a broker to help you out in making these transactions, okay, the broker charge a fee. Okay, If you have excess cash, you give, for example, 10,000 to the broker to buy for you T-bills. Okay, they charge you a fee. Okay, for instance, it can be a percent of the amount you're investing. Okay, so either way, the broker is going to charge you a fee. Okay, for transacting on your behalf. Okay, for investing your money on your behalf. Okay, the cost of making the orders. Okay, if, for instance, as you had mentioned, you're going to be having cash deficiency, what do? You need to dispose of your previous investment you made in those marketable securities, in those money market instruments. What do? You're going to be therefore be selling off those money market instruments, the T-bills, back to cash, okay, to boost your cash balances. The broker will also definitely charge you a fee for that, okay? And as I mentioned, don't forget, this is a UQ model, okay? And if you remember, let me actually, let's just give you a minute here. Check my writing area to just explain the model. Okay, so if you remember the UQ model, okay, the UQ inventory management model, we see that the Q, okay, is equal to the square root of 2 annual demand cost per order divided the holding cost per unit per year. Okay, if you're going to the Q under the Bauman model, okay, we're going to pick the same Q. Okay, the Q will be equal to, okay, 2 annual demand of cash. If for instance, we are generating, if there's need for money, you determine what's the need per month, for instance. Okay, the need per month, for instance, is, let's say, 100,000. Okay, that's the amount of cash the company needs every month, 100,000. Therefore, per year will be equal to, okay, therefore, we can say therefore per year, the amount of cash the company needs, therefore, okay, will be equal to 100,000 times 12. Okay, that's therefore the annual demand. Okay, we multiply the case in this example, the cost of the ordering cost. Okay, we say the cost you do incur per transaction. Therefore, is again the cost per transaction. Let me call it CT. Okay, cost per transaction. Okay, we divide by, we have said that the holding cost of cash is the interest foregone. Therefore, we divide by the interest. Okay, and that's therefore given therefore the Q as proposed by the Bauman model. Don't forget, it's simply the UQ model that you're trying to readapt, okay, to carry out cash management. Okay, clear, Nafisa?
Sir, could you please repeat the cost per transaction?
The cost per transaction, don't forget, as I mentioned, if you're going to, I want to use a simple example. If you do have a broker, okay, either can be a bank, okay, whatever broker you use, okay, to buy these securities, okay. If, for instance, you do use a bank, okay, you go to the bank and the bank buys on your behalf these maybe securities, okay, they buy for your behalf the T-bills, okay, they buy on your behalf the commercial papers, okay. If that's the case, therefore, every time that you're going to make a transaction with a bank, they're going to charge a fee, okay. The fee they're charging is what we call it the transaction cost, okay, the transaction cost, which is the cost per order. Okay, which is the cost per order. Okay, that we call the cost per order. The fee you do pay to the broker for every transaction they make on your behalf. Okay, clear, Nafisa?
But sir, isn't the transaction cost different, like for every transaction?
No, okay. Here, don't forget the assumption you're making is that every time you invest, you invest in the queue. You invest in that queue. You invest in that queue. So the queue is constant. If the queue, for instance, is, let's say, 10,000, okay, and assume that the broker charges you a fee of, let's say, 2%, then at the end of the day, you're investing the exact same amount of money. Therefore, the fee you're paying, for instance, is equal to, in this case, is $200. So the fee is the same. But you're assuming you're investing at a constant amount, okay, of, for instance, 10,000. So it doesn't matter. So the Q is the same. It's a fixed cost. If anything, this is an assumption that you make, okay, one of the assumptions. The cost of transaction is equal throughout the period.
Okay, thank you.
Okay. That's how we get the Q, okay? You get the Q. So simply applying the EOQ, not applying, readapting the EOQ model to be suitable to cash management or for cash management. Okay. So let's do a question, okay? I don't have a question here, so let me try to get one. Give me a minute, try to get a question. I want us to do this example. I have an example here. Yes, okay, so go through it, and then we discuss together this question here. I suppose you have gone through the question. Okay, so let's attempt to read it together. And I hope you've done something, because there's nothing strange here. It's simply the EOQ model that you're going to be using, or the Baumol model, which is the EOQ. It's the real definition of EOQ, which you've done together. Okay. So first question, anyone who has done it? Who's the Q? Anyone who has done it?
Yeah.
Yes, Brian, you got what?
15,492.
15,492. It could be, yes. Okay. Okay, the Q as per the model is equal to annual demand, cost per transaction divided by the interest. Okay, which is equal to 2 times annual demand. So the annual amount excess generated is 10,000. The per year is 10,000 times 12. Okay, times the cost per transaction. Don't forget, this company is now investing because you have more than what you need. You have more money than what you need. So then what do? You invest excess. Okay, and the fee per transaction is equal to $50. Okay, the interest could have earned per annum, because it's per year. Don't forget, it's per year, is equal to 5%, 0.05. Can you get how much, Brian? 15?
15,492.
492. You get 15,492. Therefore, to be the optimal amount of cash to be invested in each transaction. Okay. So in short, what that means that in the first month you earn 10,000. Don't invest the 10,000. Wait until the excess cash is 15,492. Okay, maybe mid of the next month. Okay, that's when you should be investing. Okay, because the Q is equal to 15,492. Okay. Next is how many transfer, or how many transactions do you make? Okay, how many investment do you make? Okay, the number of transactions or investment you make is equal to D divided by Q, or the number of orders, okay, which is equal to 120,000, the annual cash you have, divided by the amount you're investing for each of the transaction. To give us the nearest 8 transactions, I guess.
8, yeah.
Okay, therefore, to the nearest you make therefore 8 transactions per year. Okay. The next question being asked is the cost for making those transactions. Okay. Therefore, cost of transactions, the total cost of transactions. If we go as per the number of transactions you have, which is 8, which is to the nearest, it will be 8 multiplied by the cost per transaction, which is 50, to give therefore $400. Okay, with the cost of the transactions. Next is the cost of holding cash. Okay, cost of holding cash. Okay, which you say is given us. Okay, the average cash you have at any point in time, which is Q divided by 2. Okay, we multiply by the interest. Q is 15,492 divided by 2. We multiply by the interest earned, which is 5%. Give us how much? 3.
$387.3.
387.
Yes, 0.3.
0.3. Okay, 387.3. Count therefore the cost of holding cash. Okay, the amount you could have earned, the interest you could have earned during that year, which you didn't earn. Why? Because you are holding the cash until for the value of 15,492. Clear?
Just a question.
Sure.
Would you kindly re-explain that cost of holding cash? What's the logic behind Q over 2 times I?
Okay, because still that we're in the month of January, so we assume that the company has just begun. What excess cash you have? 0. Okay, therefore this is January. This is January. Okay, this is January. This is February. This is March. So you have 0 at the beginning of the year. Okay, therefore the cash you're going to be generating is going to be generated on a constant basis. So you begin from a 0 all the way to the mid of the month here, 15,492. So 15,492. Okay, so here it's 15,492.
Yeah.
15,492, isn't it?
Yeah.
Invest. What happened to the cash? It goes back to 0. Then something happened all the way. It's going to be a cycle. Okay, this is going to be a cycle, which means therefore the highest is 15,492. Okay, highest is 15. What happened here? Okay, the highest is 15,492. The lowest is 0. What's the average?
0.
We divide 15,492 plus 0 divided by 2, isn't it?
Yes.
Yeah, so the Q divided by 2. That's why it's Q divided by 2 to get the average amount of cash that the company has that is keeping. Okay, that's how this is holding. Okay.
Okay. Thank you.
Okay, and that's on the use of the BAML model. Okay, the use of the BAML cash management model. Okay. Let's discuss the next model. Okay. Now the next model, okay, is called the use of the mill out model. Okay, and this model, okay, we try to input readapt. Okay, one of the key drawback, one of the key disadvantage, okay, of the use of the BAML model. Okay, don't forget the assumption they are making, the assumption that we have just made. Okay, they are a bit unrealistic. Okay, those assumptions. Okay, one of them, for instance, is the assumption of constancy, the uniformity. Okay, when it comes to cash generation, as well as when it comes to the cash consumption. Okay, the assumption that every month you're going to be generating, or every 1.5 months you're going to be generating, every month you're going to be generating 10,000. Okay, is not realistic. Okay, there are months when things should be thick. There are months when things should be quite doing well as a company. So the assumption of that constant generation of cash or constant cash consumption is not true. Okay, in reality, they of course they call it business cycles. Okay, month of December as a retailer you do very well. Okay, as a constructor maybe you're not doing so well. Okay, so that's the reality. It'll be up and down. Okay, so the assumption of that business cycles are the same is out of touch with the reality. Okay, that's why we have the middle old model coming in to put into reality. Okay, what the middle old model comes in is to put or call the best thing when it comes to cash management. Okay, as per the middle old model, is for the company to establish what we call the limits. Okay, to know what should be the minimum amount of cash we should be having, such that we don't have a risk of illiquidity, and what should be the maximum amount of cash we should be having as a company, so that we don't end up hurting our profit, because you want to earn money. The more cash you have at hand, the less profit is making. So you want to invest the money. Okay, so the middle model comes in to try to establish these limits. Okay, to establish these limits. Okay, getting to know what should be the maximum, what should be the minimum. Okay, get to know what the maximum and what should be therefore the minimum amount of cash that we ought to be keeping. Okay, so the idea here under this model is that the cash can go up or down. Okay, provided it doesn't go beyond the lower limit, neither does it go above the upper limit. Okay, if the cash balances are in between, then that's okay. Okay, there's no problem. However, if the cash balance are going to be above the upper limit, below the lower limit, then there's a risk. Okay, so for this model is about trying to establish what should be the right amount of cash that you ought to be having. Okay, what are the limits? Okay, it's not about sticking at a queue of something. No. Okay, the idea is that we want to ensure that the cash balance at any point in time, they don't go beyond the upper limit, they don't go below the lower limit. Okay, that's the idea. We have like the middle model. Okay. Let me actually let me explain these limits through my notes here. Okay. Okay. So you want to establish the limits. Okay. So you want to determine therefore. So the company therefore. Okay. I want to establish the upper limits. Okay, so first is to get to establish the lower limit. Okay, assume that's my lower limit. So determine the lower limit. Okay, determine what we call the upper limit. Okay, so this is time. This is the cash quantity. Okay, this is quantity of cash. Okay, so as you mentioned, don't forget, we don't want to have a case where the cash is above, is here, this point here, it's too high. The cash is below this lower. It's the risk of being illiquid is too high. So you want to ensure the cash balance is in between these two. Okay, between the upper limit and the lower limit. Okay, not above, not below. Okay, if possible, should be at those two limits. Okay, upper limit and the lower limit. Okay, upper limit and the lower limit. Okay. So how do we establish these limits? That's the next question. How do you know what's the upper limit of the company? How do you know what's the lower limit of the company? Now, the lower limit of the company, okay, this is again be established by the management, okay. For instance, one of the easiest way of trying to establish the lower limit is observe. Maybe we're in the year 2019 now, okay. So observe for the past 1 year, 2019, okay, between maybe September, okay, all the way to September last year. Okay, what has been the cash what has been the minimum? Okay, assume this time is in month, for instance, this time is in months. Determine what has been the minimum amount of cash that we consumed for the past one financial year. Okay, so that minimum can become your minimum going forward. Okay, so this can be done through a historical analysis of the company data. Okay, so as I mentioned, between September of this year and September of last year, observe what has been the minimum amount of cash maybe you're able to generate, okay, or consume or you required. Okay, so you can therefore the minimum amount of cash the company we ought to be keeping at any point in time. Okay, now to establish the upper limit, okay, generally you know say that the difference between the upper limit and the lower limit this here is called the spread. This is called the spread. Okay, which means therefore we can say therefore the upper limit. If you know the spread and you know the lower limit, then the upper limit is really easy to get. Be equal to the lower limit, okay, plus the spread. Okay, let's get the lower limit plus the spread. Okay, now the spread, okay, is influenced by a number of factors. Okay, so the spread, the difference, is influenced by a number of factors. Okay, let's explain it. Now, if for instance, we do have the cash volatility. Okay, let me just explain here. Okay, those two scenarios: scenario A, scenario B. Okay, scenario A and scenario B. Okay, this is B. If the cash balance, okay, if this is how the cash balance are behaving in scenario A, okay, movement up and down, okay, because that's the reality based on business cycle. Okay, and this is the cash balance. Okay, now where do we have more variance, more volatility? Okay, A or B? This is quantity of cash, this is time. This is quantity of cash, this is time. Where do you have more volatility?
A.
If you have more volatility, there's more volatility, there's more risk. You have to use that term. Okay? There's more risk in A. Okay, why? Because the cash can move from 10,000 to almost $10 within a very short time. In this case, the change is quite minimal. Okay, but you can do tell that if today, if we are at the peak here, then the next is going to be still be a high value. Okay, but here it can be at 10,000. Then the next minute it is at 0, okay, or maybe at a very minimal value. So here you have more risk, they have more volatility. Now the question is, where do we need to keep more cash? Is it A or is it B as a company? If you remember, we discussed the reason of holding cash. There are two: speculation, to pay for the transaction, and the last one was
Precautionary.
Precautionary. Okay, in this case, more towards the precautionary. Okay, now if we have a case where this is the movement is scenario A or scenario B, where would you want to keep more cash for the sake of precaution? Is it A or is it B?
A.
A, of course. Therefore, the need for cash is going to be much more greater in scenario A, where you have more volatility. Okay, where you have more volatility. Okay, which means therefore the spread is going to be higher because there's more volatility. You're keeping more cash. Therefore, the spread is greater. Okay, therefore, the more volatility you have, the more spread will be. The greater will be the spread. Okay, therefore, one of the factors is volatility. Okay, volatility. Okay, how volatile is it? Okay, and the measure of volatility is the variance. So let me just use variance. One of the measure of volatility is the use of variance. Okay, which I think you did learn years ago. The use of variance analysis. Okay, so the more variance, the more volatility, the more money you would want to keep because the risk is high. Okay, it's like the case of suppliers, where if suppliers, if you're very sure supplier take 2 weeks and they take 2 weeks, okay. So therefore, in that case, for the company, you keep less inventory, you keep less buffer stock. But in case supplier, okay, as per the agreement, they meant to deliver in 1 week, but sometimes they can even deliver 6 weeks later. Okay. Now, where do you keep more? You keep more inventory. You do keep more inventory where there's more risk, where there's more value, where there's more a chance that the supplier might not honor the terms. Okay. The same thing is applying here. Okay. The more volatility you have, okay, there is a chance you keep more stock. Okay. Then the next factor could be the cost of transaction. Okay, don't forget, as we had mentioned, that every time, in case you have excess cash, what do? Okay, you would want to invest. Okay, if you have cash deficiency, what do? You don't want to dispose of your previous investment. Okay, to generate cash. Okay, so that you can boost your cash balance back to what you want. In quote the norm. Okay, let's call it the norm. Okay. Now, in case the cost you're paying to make this transaction is high, okay, if the cost you incurring to make this transaction is high cost, okay, if the cost is high and the cost here is low, okay, let me call it A and B. where would you want to keep more cash at hand? Is it A or is it B? Don't forget to say that in case you have excess cash, invest it. If you have cash deficiency, what do? Dispose of. Okay. Now assume the fee you're paying. Okay, this is the fee you're paying to the broker. Okay, the fee you're paying to the broker is $10 per transaction, and here it's $2 per transaction. Now, where would you want to have fewer transactions with the broker?
A.
Of course, A. Okay, because they're charging you high fee, but you would want to avoid having a lot of transaction with the broker. Okay, which implies therefore, since you're having fewer transactions with the broker, what happens to the spread? Does it increase or decrease? Guys, let me repeat just in case you never understood the question. If the fee you're paying, we say that.
Please repeat that.
Okay, so if the fee you're paying to the broker, okay, in scenario A is quite high, okay, you're paying $10, okay. Now, where would you want to therefore keep? We say that the number of transactions you make with the broker is going to be low in scenario A. Okay, you say that, isn't it? You have fewer transactions in A. Okay, clear?
Yes.
Yes.
Okay. Now the question is therefore, since you have fewer transactions in scenario A, what happens to the cash balances? Are they high? Are they low?
So what is the question? What happens to the?
Since we have said that in scenario A, you're going to be having fewer transactions, isn't it?
Yeah.
Okay. So the question, therefore, what happens to the cash will be? What happens to the cash balances? Your cash balances, okay, at hand.
It's lower.
Where is it low? And you're not investing.
The money the cash we want to invest in.
Okay. Don't forget to say that in scenario A, you're going to be investing less. In scenario B, you have more investment because the fee is low. Okay. Now I'm asking, what happens therefore to the cash you have at hand, the cash balance you have at hand? Okay. In scenario A, is it going to be high? Is it going to be low? Okay.
After what? Before the transaction or after the transaction?
Okay. In both cases, okay, we say that here the transaction these are fewer transactions. These are the numbers are high, okay, high number of transactions, okay. So we are massing. Okay, the amount of cash you're able to generate, for example, okay, is the same. Assume that every year is 120,000 for both cases. Okay, is 120,000. But now you have fewer transactions in scenario A. You're investing less money. You're investing, for example, not less money. You're investing, okay, fewer times, okay, in scenario A compared to scenario B. Now, where do you have more cash at hand? Is it in A or is it in B?
In B, you'll have more cash.
In B, you have more. In that case, in B, you're going to be having more cash at hand, okay, because you're investing less money. So you have more cash at hand, therefore, okay. Don't forget the option are either invest or have the cash at hand. Those are the two alternatives, okay. So if you don't invest the money, it means you have more cash at hand, okay. So it seems you have in scenario A, you have fewer transactions. That means therefore you have more cash at hand. Therefore, the spread is going to be influenced by the cost. The higher the cost of transactions, the lower becomes the higher becomes the spread. Is it clear? The higher.
Could you please repeat? Yeah, could you just repeat the last statement you said?
Here, so the cost is high, and you see that here the spread is high. Isn't it? The cost is high and the spread is high. Okay. If the cost is high, the amount you're paying to the broker is high, then you have fewer transactions. Then you have more cash at hand. The spread therefore is high. Clear there? Is that clear?
Yes.
Okay, great. Okay, therefore, going back to a spread, the other factor that influences the spread, okay, don't forget here there's direct correlation. There's direct correlation. The higher the cost, the higher the spread. Okay, therefore, the next factor, therefore, here that influences, therefore, the spread, okay, is therefore equal to the cost per transaction. Let me call it cost of transaction cost. Okay, transaction cost. CT. Let me go CT. Okay, cost of transaction. Okay, variance times the cost of transaction. Okay, so the next factor. The next factor is on the interest. Okay, the holding cost of cash. Okay, interest. Okay, assume that the amount of interest you can earn upon investing in A is let's say 10%. In scenario B is let's say 3%.
So what is the formula you wrote? Like variance times transaction cost?
Oh, it's not yet over. So we shall go back to it. Don't worry for now.
Okay.
It'll go back. It's not. This is incomplete. So don't write it for now. So the next variable, okay, that influences the spread is the interest. Okay, the amount you could have earned if you had to invest the money. Now in scenario A, if you invest the money, you earn 10%. In scenario B, you earn 3%. Where would you want to invest frequently?
B.
Sorry?
B.
B.
B. Where
Yes,
would
yes.
you want to be? Now here,
Huh?
if someone is giving me 10% and someone is giving me 3%, where would I want to invest my money in?
A.
Definitely it's A. Therefore, I'll be investing more frequently in A because they're giving more interest. In B, the interest I'm earning is very low. So what will therefore happen? I'll be giving more cash to myself because they're giving very minimal interest. Okay. So here you're going to be having low investment, or this you're going to be having a lower number of investments. Let me just, okay, here you have higher number of investments because they're getting more interest. They invest more in money in them. Okay. Now what that means is that if you have to consider in the case of the spread, okay, so since you have more investment here, okay, you have more investment there, what happens to the cash at hand? Is it high? Is it low?
It's high.
Think. Since you have more investment making here, what happens to the cash at hand? Is it increasing? Is it decreasing?
Decreasing.
It's decreasing. So here you have low cash. You have the spread is low. The spread here is going to be low, therefore. Okay, because you're going to be investing more money. Okay, you're going to be investing more money. Okay, you don't want to keep the cash. You're going to you don't want to invest the cash. Therefore, what happens to the cash at hand? It's going to be decreased definitely because you're giving up money for the investment. You're giving up money for the T-bills. Okay, therefore, the higher the interest you be earning, the lower becomes the spread. Okay, you can see here we have inverse relationship. The higher the interest you're earning, okay, the lower becomes the spread of the cash. We have inverse relationship here. Therefore, we have to take the same in our formula, inverse. Therefore, we divide by, okay, here by the interest. Okay, we divide by the interest. Okay, those are the three variables that generally do influence the spread. Okay, so let me the spread formula, okay, is given as 3. Okay, don't know where the 3 comes from. Okay, this is a stochastic model. Okay, so 3 or 4. Okay, the power of the cube roots. Okay, to multiply by 3. Okay, and that's kind of for the spread. Okay, so don't worry about where 3 is. This 3 and a quarter, and then the cube will come from. As I mentioned, this is a stochastic model, but I can explain the variables, okay, which I've tried to do: the variance, the cost of transaction, and the interest rate. Don't cram the formula. The formula will be given to you by the examiner. Okay, so don't cram it. Okay, so but it's good to know how to apply the formula, and that's how you get there for the cost of the spread. That is okay. Once you have the spread, you can get the upper limit. Okay. Once you have the spread, therefore you can get therefore the upper limit. Okay. Now, the company may be having what they aim on the what called the cash balance they are aiming at. Okay. At what level do you want our cash to be at? Okay. So here the company may be having called a return point. Okay. We'll call the target cash balance. So they may be having target cash balance that falls between them target cash. Okay. Target, or we'll call the return point, target point or the return point. Okay, so the return point, okay, it's where the company aims, okay, to have its cash balance at. Okay, it does not have or be too concerned, okay, if the cash is not at the target point, provided it is not above the upper limit and not below the lower limit. Okay, but there's what the company aims to have its cash balance at. Okay, they aim to have a target point or the return point. Okay, as mentioned, if the cash is getting in between here, like in this point, okay, the concern is a bit low. Okay, why? Because it is not yet beyond the upper limit. Okay, if the cash is going to be at this point, the concern is a bit low. Why? Because it's not yet below the lower limit. Okay, but if the cash is going to be above here, then the company must it should not even go above, in short. But if by maybe out of negligence it goes above, then that's a huge concern. We need to reduce the cash balance to the target point. Okay, back to the target point. If the cash balance approaches the lower limit, we need to boost the cash balance back to the return point. Okay. The question therefore is, how therefore do we determine the return point? Okay, how therefore do we determine the return point? The return point is given us. The return point is given us the lower limit, okay, plus a third of spread. Okay, that's together for the return point. Okay, the lower limit plus 1/3 of spread. Okay, that's together for the return point. Okay, now once you have the return point, okay, once now you have for the return point, okay, now you can be having the cash balance, okay, moving up and down, okay, provided it doesn't go beyond the upper limit, it doesn't go below the lower limit, okay. So if, for instance, let's just go to the graph, okay, if the cash balance, don't get as mentioned, the reality is that cash is going to move up and down, okay, so the cash can have moving up and down, just moving up and down, ensure it doesn't go beyond the upper limit. So if it is at the upper limit, we need to reduce the cash back to the target point. So we reduce the cash back to the target point. Okay. If the cash balance goes straight to the lower limit, okay, like that way, we need to boost it. Okay. We need to increase the cash from the lower limit all the way back to the target cash balance. Okay. At this point. Okay. Now the question therefore is that how therefore do we reduce the cash balance? How therefore do we increase the cash balance? Okay. So you say that to reduce the cash balance, you need to invest the money. Okay. So here at this point in time, okay, this is invest in T-bills. Okay, invest in T-bills or in the money market instruments. Okay, you need to invest in the money market instruments because you have more cash than you need. The target is to have the cash balance should be at the target point, but now it's at the upper limit. Reduce it. Okay. In this other part here, okay, you see that you need to increase the cash balance because you don't want to run into the risk of being illiquid, insolvent, okay, because you have very low cash balances. What do? You boost the cash balances, okay, you dispose of your previous investment. So here, okay, make a sale, okay, sale of maybe money market instruments, okay, treasury bills, okay, this is money market instruments, marketable securities. Okay, so sales make a sale of the T-bills to boost the cash balance back to the target point. Clear? Okay, and that's on the use of the Miller-Orr model. Okay, the use of the Miller-Orr model. Nafisa is clear?
Yes, sir.
Okay, Brian.
Yes, yes.
Okay. Sakina, is it clear?
Yes.
Okay, great. So that's simply how you manage the you do manage the cash through the use of the money, through the use of the Miller-Orr model. Okay, through the use of the Miller-Orr model. Okay. So the idea is that okay, the cash can move up and down as you've seen here. Okay, the cash can move up and here. Okay, so here, as I say, the cash can move up and down. That's the reality. Move up and down, up and down. That's the reality. The idea is that it should not go above the upper limit. Okay, if it is going to be approaching cases where the need for cash is quite high, as you can see, is moving down, and ensure it doesn't go below the lower limit. Okay, you need to boost it back to the return point. Clear? So these formulas will be given to the youth in the exam. So you don't need to cram them. Okay, the idea is that you should be able to apply them, okay, not to count these formulas. Okay. Any question? Okay, no question. So let's attempt a question. So we'll discuss that, the spread. Yes, I can do this. Okay, so go through this question. Okay, Mark, first make the attempt of this question. Make the attempt first, because it's simply applying the formulas. There's nothing strange here. So first make the attempt, then we shall do it together.